Hello friends, welcome to my channel Stock Market Investment. If you are visiting for the first time, please like, subscribe, share, hit the bell icon for regular notification and updates, and punch in your comment if any. This will motivate me for more upcoming videos. So let's start the video. So at present, Indian stock market, as we all know, is going through a turbulent phase. And the downside is it triggers panic among the retail investors. And this happens every time when the stock market falls, corrects, or it crashes, forcing retail investors to doubt their own investment done so far. And they run into panic mode and they sell off to cover their losses. So we will briefly look into 7 key points which every retail investor must have in their mind to avoid such panic situations which may result in heavy loss. We look into the crash history. We'll also cover external factors, global factors, news which impacts the stock prices. We'll look into the fundamentals, how this is going to benefit when the market is really going down. We'll also look into the notion of sell now, buy later. Is it something right which retail investors should be looking forward to? Then there are certain questions which retail investors need to ask themselves in the falling market. We'll also cover advantages of long-term investing. And at the end, there are certain habits of retail investors which we need to change, which is going to benefit us in a falling market. So now let's look into the crash history first. So we all know that Sensex has been there since 1986, and it has been almost roughly 36 years since its listing. And this is not the first time it has fallen, corrected, or crashed. But there are multiple instances when it has crashed more than 5% in a single day. So let's look into these instances quickly. We will only discuss last 20 years data for Sensex here. So if you look here, in 1992, Sensex was somewhere around 3870, and till that time it has a yield of a return of 590%. And if you see here, folks, there are multiple instances when the stock market has fallen. On 28th April, it has a dip of 12-point crash of almost 12.77%. Harshad Mehta scam, we all are aware. Again, in 18th May 2006, it has 6.76%. Again, the US financial crisis came up, I think in 2008, again 7.4%. In Jan, then in March 6.3%, again in October 2008 10.95%, August 5.93%, and November 2016 we all know with the demonetization what has happened. So it led to a 5.9% crash in the Sensex. And if you look into 12th March 2020, I think we know it was a major impact into the share market where we had, because of COVID, we had multiple dips within a month, which we can see here. In the month of March itself, you can see there are multiple dips of 8.1%, 7.96%, 23 March again we have 13.15%. So the whole point of reviewing this market crash history is what happened to the market. So now let's look into the Sensex matrix for 2022. So despite this roller coaster ride, every time after a great crash, it has come back more strongly. And investors who have not exited in panic have reaped the benefit of the bull run. So if you're really invested for long, you see what has happened here. As of 23rd June 2022, Sensex is roughly at 52089, and it has provided a return of 9184%. So despite all these crashes and these hiccups in between, for the last 20 years, you see where Sensex is today. So do retail investors need to be in panic mode with the market correction of this? The answer is no. Now let's look into the second point, that why a market has crashed or corrected. So during market crash, correction or fall, it's very important to gauge the factors driving the market crazy. We will look into some of the examples as there can be many factors which may lead to bearish trend in the market. So there are certain global factors which impacts the market, like Russia-Ukraine war, which has created panic across the globe and impacted market across the world. I think we all are aware of it. Fed rates. Fed rates hikes and multiple interest rate hikes even in India to curb inflation has also created a negative sentiment in the market because it's not a good sign for the economy. Crude oil. Yes, we all know crude oil has affected each and every nation. And since India imports almost 80% of crude oil, it affects our day-to-day life significantly. From wanting toothpaste to dining out in the restaurant, we fall a prey to inflation. And this badly affects share market as well. So these are some examples of global factors. Now let's look into external factors. External factors like GST, recently the GST rate was hiked for the footwear industries, which led to the fall of relaxo footwears and other footwear related stock. So these are external factors which may impact the stock as well. Things like export restrictions. I think the government decision to have ban on steel export also impacted steel related stocks like Tata Steel, for example, which we see. And then accident and mishap are also external factors which can impact a stock. We know when a fire broke out for Deepak Nitrite chemical plant in Gujarat, it led to its stock crash. So these are the external factors which may impact stock as well, some of the examples. And then this is news. So there can be a news related to a stock which may impact negatively. So we may have to look into stock specific news. So we all know post the Jubilant Food, I think, which is associated with Domino's pizza brand. Post the CEO of the Jubilant Food resignation, the stock fell apart. So these are factors which a retail investor has to analyze, the global, external, or is it news specific. Some examples, there can be many more, which you need to analyze that are these factors involved. If any of these factors are involved for a stock crash, there is something to be panicked. There is no reason to worry about. You can remain invested. Now let's look into another point, which is about the fundamentals. Because in a falling market, the very first thing which comes in our mind, oh, the stock has crashed 20%, 40%. What to do now? Let's sell it off. So you need to check the fundamentals of a firm, that what is happening around the stocks or the firms which you have invested. And what are the key things which a retail investor should look into? We look into some reports like what you need to know, your stock, some reviews, what are the factors which is there. So very first thing is you have to look into the sales number. It's very important, how the sales are moving up. If you're not analyzing sales and you are invested, you're definitely making a fool out of yourself. Another thing to look into is net profit. You really need to monitor how the profits have been moving up. Expenses, because if expenses are not controlled, it may lead to a serious loss, which we can see in case of Zomato. Like they are doing exceptionally well in terms of sales, but because of their expenses, they're not able to make profit. So to control your expenses is very important key aspect. Debt, whether a company has debt or not, because if you're running into a debt, that's not a good sign. Definitely there is an exception where small cap or mid cap firms need to take debt because that is very much required for their growth, because they don't have surplus reserves. Cash flows, yes, definitely you have to see how the cash flows are moving up or down. And based on that, you can take a decision that, okay, there is something negative or there are some alarming signs or not. So you have to look into sales, net profit, expenses, debt, cash flows to read this, to see what is happening in a firm. And not only this, you have to know your stock, like we say, when banks ask to know your customer, right? They ask you to fill in some details including. So you also need to know your stock which you have invested. Inventories is another thing which you need to care, like for companies like footwears and others, they need to have a big inventory. So you need to check like how big the inventories are, because that shows the confidence of a firm, the market, the sales, all are driven by how much inventories they have. Now coming to know your stock, I think we have to look into management, because if you don't know how the management is, what decisions they are taking, how the management is shaping up, having the futuristic plan, roadmap, then definitely that company may not reach the desired milestone, which any retail investor would have invested thinking that in mind. Another thing to look into is customers, like what are the key customers? Are there big customers associated with any firm or not? Next, we should look into the products. Are there international brands which a company deals with, like brands across country, across the globe? Do they have such brands or products or not? Because that tells you how big or what is the reputation of a firm across the globe. Sector growth forecast, which is very important because you need to know which sector you are investing. Because if you have invested in a sector like EV or the energy, green energy, The electric vehicle, green energy sector is definitely going to boom with the running requirement across the globe. So we have a very good forecast, and there is a very positive sign of growth in this sector. So you need to know which sector you are investing. Now, reviews are equally important. You need to review quarterly results. If you're not reviewing quarterly results and if you have invested for long term, you're definitely not going to make big profits. You have to analyze quarterly results and annual results. Yes, it looks like a pain, but please remember this. If you have invested your money, your hard-earned money, your lifelong money, you need to do this. If you're not doing this evaluation, you will definitely end up in big losses. Shareholding pattern is very important because it gives you a clear indication of how the foreign institutions, domestic institutions are feeling about the stock and how promoters are feeling about the firm. Because if they are running away, definitely it's a danger sign. But yes, if they are buying, should you go and follow them blindly? No, it's not. You should never follow them blindly. You have to do the fundamental analysis, look into all other aspects like the report, know your stock, and then only look into reviews or the patterns which we have. Because if the fundamentals of sales and these things are wrong, reviewing your quarterly results and annual results or looking into shareholding patterns have no meaning. And then whether the firm has any placed shares or not. So if you are aware of these kind of informations like the report, know your stock and reviews, if you're doing this, then even if the market crashes 5%, 10% or 12% crash, you'll not feel like exiting the market and selling off the stock and loss. You'll never book losses. So please review this, have this on background of report, know your stock and reviews. And if you are a aware retail investor, then definitely you'll never panic in a falling market. Now let's look into another aspect which comes with market correction on crash in the minds of retail investors is like, oh, the market is constantly falling. What should I do? Shall I sell it now? And later I will buy when the correction happens 20-25% more so that I'll have more stocks and I'll make more profit. It sounds really simple and easy and looks good also in the first place. But is it really possible to time the market? And yes, at times things may go our way, but what if it does not? Will you end up making a profit or will you end up making a loss? Let's try to understand this conception of sell now, buy later, which comes to every retail investors in a falling market. So we'll try to understand this with an example. So let's say there is Mr. X. So what Mr. X does is he buys one stock at the stock price of 100. And let's say after some span of time, let's say a year or something, which happens to all of us, there is a correction in the market and it falls by 10% and the stock trades at 90. Now what happens here is, as it has fallen by 10%, and being a retail investor, Mr. X is really impatient, is thinking, oh, I'm already incurring a loss of 10%. Looks like market is going to fall further and let me sell it off and I'll try to buy later when this correction really stops. So what Mr. X does in panic mode, he ends up selling his stock. Definitely he incurred a loss of 10% here, which we can see here. And after that, what happens? Market further corrects and comes to 85. Then again market further corrects and the stock falls to 80. Now looking at this, Mr. X is really happy because he has done a fabulous job of timing the market and selling it at 90. So Mr. X is very happy. He's all smiling. That look, I have sold at the right time. If had he been invested, he would have incurred a 10% more loss on his buying price, right? Because stock has fallen to 80. So now Mr. X waits for more correction because he doesn't know whether the market is going to correct more or not. So he's looking that the market should hit the bottom. And once it starts picking up, maybe he'll reinvest at that point of time. So Mr. X is waiting for further correction. And what happens here is, suddenly there is a positive news and the stock soars 20% and moves to 96. Now folks, pay your attention here. Here Mr. X has not got a chance to reinvest or re-enter. And before he could make a decision because he was waiting for further correction, the stock has fallen, shoot up to 96, 20%. Now as Mr. X really likes the stock and he wants to own this stock again. So he thinks, okay, now as I have missed this opportunity, Let me go and buy here because now the prices may go up further. So Mr. X buys again at the price of 96. Now the whole idea of explaining this, folks, is that what happened here, how smart we are, many times we won't be able to time the market. Because if you're able to time the market, you all will be richy rich, right? Everybody will gain, nobody will incur losses. But that's not the reality. The reality is something which has happened to Mr. X, happens to most of the retail investors. Please comment and let me know if it has happened ever with you folks as well. So what is the moral of this whole small short story which I have narrated here? That Mr. X had one stock which he has bought the price of 100. Then he booked a loss of, sorry, I think it's 10. He booked a loss of 10 rupees. And then he reinvested at the cost of 96. So what is the final buying price of Mr. X is he incurred a loss of 10 rupees here because he bought at 100, sold at 90, and then he again bought again in 96. So his has a 10 rupees loss here plus 96 he has put. So his total final buying price becomes 106. And now with the stock price as 96, how much is the loss Mr. X is bearing now? It's loss of 10 rupees. Now if Mr. X would have been stayed invested in the stock despite all this because the company's fundamental and things were fine, he would have just incurred loss of 4. And on recovery, he would have been able to regain his buying price. So the whole idea of explaining this example is there will be times where you won't be able to time the market. And this happens to retail investors most of the time. You cannot outsmart the market. You may sometimes, but not always. So if the company's fundamental is good, what we have observed in our previous points, that if you review and everything from the company's fundamental perspective is fine, there is no need to panic and time the market and sell it off. You remain invested and you may incur less loss when the market regains. And folks, market has always recovered. You check the history of Sensex, it has always recovered. 2020 is a classic example which has happened most recently. 30-40% market has fallen. And what happened? Now you see. The market shoot up in 2021 like anything. So now also we are seeing correction of 20 to 40% in most of the good stocks. If the company's fundamentals are fine, then it's time to buy them rather than sell them off. So hope this notion of sell now and buy later is clear, and we really understand that if you are investing for the long term, we should be invested, and if you're trying to time the market, you may end up making more losses than profit. Okay, so let's look into another aspect or another question which comes for retail investors. You need to ask a couple of questions in this market turbulence time or this market correction time. What are these questions which any retail investor needs to ask themselves? Let's have a look into it one by one. The very first question you need to ask yourself that why you have invested in the stock, in any stock. There should be a strong reason for you to invest. If you have just invested by hearing something from your friends, relatives, or here, then definitely you have made a mistake. You may make a gain for short period of time, but that kind of decision making will not let you hold the stock for long. You will come under panic mode in market crash or correction and you'll end up selling them. So it's very important that you have bought a stock based on strong fundamentals or research and analysis, not just by watching some YouTube videos or hearing from friends, family, or this and that. So this is very important, folks. You need to find out why you have invested in the stock. If it is based on some fundamentals and conviction, then because of the market crash, that is not going to go away, right? What is the second point? What is your goal, like, or the objective? If you have come here for a short-term goal or a long-term goal. If it's a short-term goal, you need to sell at that point of time. If it's a long-term goal, like 5 years, 10 years, 15 years, 20 years, then you really need to hold for that time. Market will have its fluctuation or hiccups, but you are going to make a killer or make a fortune only if you're invested for a very, very long time. So try to figure this out. If you have invested for a long term, because of the sudden crash or correction, you should not sell them off. The next question you need to ask yourself is anything seriously wrong with the company fundamentals? We have already covered that you need to review. So if you review and if everything is fine from the fundamental perspective, you really don't need to worry about and go into a panic mode. Because companies' fundamentals are fine. Stock prices may go up and down. The prices are moving up, it doesn't really shows that company is doing fabulous. It may or may not. And the same case applies if the stock price is falling down. If company business is growing, everything is fine, the fundamentals are good. Even if it crashes 10 to 15%, should not be worried. You are here for a long-term investment. You have to be firm on your decision. So, as I covered, right? So market crash and fall must not impact the decision. Okay, it has fallen 20%, I should sell it off. No, it has fallen 15%, let me sell it off. No, this is not the criteria. If you really want to make a good amount of profit, you need to wait for long term. It will not happen in 5 months, 6 months, or within a year time. It may or may not happen, but this crash and fall should really not dilute your decision for your investment. So that's where you need to remind yourself that look, these crash and falls are temporary triggers which happens in stock market, and it will happen every 1 or 2 years or 3 years. Market falls or corrects, and we have to be ready for this. If you're not prepared for it, then definitely you should not be investing in stock market. You should stay away from stock market. Now let's look into another aspect, right, which we covered, that company's business is growing well, company is making consistent profit. There is no need to panic. Just review this, be invested. And we also look into for firms like Asian Paints, Hindustan Unilever. These firms are very old firms. These have history of 20, 15, 20 plus years of history. And you see, they have faced maybe 8 to 10 times market has crashed in the past, or Sensex history if you see. And every time these stocks have recovered and they have dealt with it. So the company has a knowledge of really dealing with this crisis situation. And that is where your confidence should come also. Like companies like Asian Paints, Hindustan Unilever, they have seen all good things and bad things over the years, 20 years time, plus years time, right? So they know how to manage the business, how to handle their customers. So this history is also very important. If some stock is relatively new, yes, you need to be a little concerned. But if you have invested in stocks like Asian Paints or Hindustan Unilever, you really need not be bothered because they have a history of dealing with this crisis situation. And you need to be firm on your investment. You need to back yourself on your investment. So I hope, folks, you need to ask these tough questions, market correction or crash phase. So always remember these points. Ask yourself, and if you get negative answers for all these questions, you can think of going ahead and selling off a stock. But please question this before blindly going into a panic mode and selling a stock. Now let's look into the sixth point, which is advantage of long-term investing. So it's very important for any retail investors to know that if you've invested in any stock, you have to stay invested for almost 5+ years, 10 years, 15 years of time to reap the benefit. If you're looking for a quick gain in 1 month or 2 months, I think it comes from trading but not from investing. So let's look into some examples of advantage of long-term investing. So if we look here, this is one large cap stock, and let's look into the return of the stock. For 1 week, minus 5%, 1 month, minus 3.5%, 6 month return is 5.94% positive, 1 year 13%, 5 years is 253%, 10 years 588%, and max 20 years is 4643%. So if you look into this large cap stock, you see the power of holding any stock for long. See the power of long-term investing here. If you've invested for only 1 year, okay, you definitely make better than a fixed deposit. But look how good returns are for 5 years, 253%, 10 years, 588%, and 20 years you look into 4643%. So this is in terms of large cap. And let's look into one mid cap example. So 1 week minus 8, 1 month, 6 months minus 21% of fall. 1 year is almost minus 11% of fall. 5 years 300%. So if you look here carefully for this mid cap stock, as they may fall much sharper than the large cap stock, which is ever, a retail investor really have to keep patience, because you see for almost 1 year there has been no positive return for this mid cap stock. And this is the time where most of the retail investors will panic and will run away, will exit, will sell it off. And then when it starts doing well, they will go back and buy again. But look how good return it has given in terms of 5 years, 10 years. Yes, the risk is more with the mid cap, but the returns are also much more rewarding. See, in 10 years only it has made 4,480% of return. And in 11 years, as for this stock, has given 6,849% of return. So just have a look into this. And if you look into one small cap, in 1 week, 14, it's a small cap, so the fall may be really very bad. 1 month of 13.62%, 6 month is 34.91%. See, it's a small cap stock, so here the fall may be very, very high, 30 to 50% of fall. It may happen. So being a retail investor, if you are firm with the company's fundamentals, you need to stay invested. If you panic and sell it off, you're not going to make profit in the share market. Let's look here. 1 year, 36 point. We don't have 5 years and 10 years data because it has just been 2 years of this small cap stock, which I've taken example into listing. But even then, if you see less than 2 years, the stock has still managed to give you 17.58% of return, which is much better than a fixed deposit. But to achieve this or to reach to these points of 10 years, a retail investor has to go through the pain of seeing the stock fall of minus 21%, minus 11%, minus 34% in 6 months, even 36% in 1 year. Now we have seen most of the stock has fallen 20% also. So the whole idea of telling this stock small cap, large cap, mid cap category is whatever category of stock you have chosen. Small cap, the fall may be much more sharper, then something better in mid cap, and large cap will be further better. And if you look into, want to know the stock names, so here it is, right? This is for Reliance, this is the returns for Relaxo Footwear, and this is for Route Mobile. So please understand the advantage of long-term investing. Don't look into 1 month, 6 months quick returns. You have to be invested for long to reap the benefit. If you know the company's fundamentals, whether it's a large cap, mid cap, or small cap stock, doesn't matter. You have to be, the company's fundamentals are good, you have to be invested for 5+ years horizon, because that's where you start making big benefit. If you're here for 1 year or less, whatever stock it is, you may make profit at times, but most of the times your return may not be that much rewarding. Now let's look into the final point, the 7th key point which a retail investor should keep in their mind. It may look like a gyan or something like, oh, we are already aware of this, what's new in this? But please make a note in your mind that if you're really following this or not. So you need to change your habits, because there are certain habits of retail investors which land them into a problem in a falling market. And what are these? We'll just have a quick look into them. Panic decision. Never take any decision in panic. Whether you have to sell the stock or not, think over it, look into the fundamentals. Never try to sell the stock because market has fallen 20% in panic. Remember, in panic, you'll never make a good decision. Second key point is avoid daily portfolio review. In a falling market, if you're firm with the company's fundamentals, there is no need for you to look into a portfolio every day. But most of us, have a habit of looking into portfolio, and the more you look, you'll go more into depression. You'll see, I'm making this much loss. Oh my God, my losses are too big. Shall I quit now? Is it the time to exit? I will re-enter again. So such kind of thoughts will come into your mind. So please avoid looking into a portfolio daily. Another important thing is don't copy others, because every individual has their own objective, their milestone, their goals may be different. Just because you are watching YouTube or your friends or family or somebody has suggested, or some big guns like Junjunwala, Vijay Kedia, all these guys are buying some stock, don't follow any of them. You always have to do your own research, look into the company fundamentals, annual reports, and then only you make a decision to invest. If they are buying, they are selling, you never follow this. You may make gains at times, but if you follow it for a long time, definitely will incur losses. So please keep this is very, very important point to make a note that you never copy others. Have your own objective, own analysis, and then invest or sell any stock. And the last point which I want to make here, that if you really need to make a decision and you are still not sure, at the end what you can do is you can seek advice from financial advisor or any expert who are there in stock market for long. If you're not able to make decision, that is the only last resort. So friends, please keep these 7 points in mind. And I hope if you follow these 7 points, whether the stock falls, corrects, or crash happens, it will definitely not bother you. Happy investing. Thanks for watching the video. And if you have learned something new today, then do hit the like button. Please subscribe, share, hit the bell icon for regular updates. Till we meet up in our next video. Bye bye and take care.